All right, we're ready to start here, part 2, with the withholding allowances, and we're going to be doing a couple examples along the way with this, and then especially in the next part where we actually look up your taxable income to see how much tax liability is owed for each return. All right, the first thing here, withholding allowances. Before an employer can determine how much to take out of your weekly or biweekly check, you need to fill out, when you start working somewhere, every employee must fill out a W-4. When you fill out this W-4, that allows the employer to look up on the IRS charts how much taxes you should have taken out each paycheck. Now note, you could refuse to fill out the Form W-4, but if you do, you're going to have taxes taken out as though you are single with no allowances, which means the absolute most that could be taken out for your pay will be, since the IRS doesn't know how much to really withhold since you did not fill out the Form W-4. What this W-4 does, again, it specifies exactly how many exemptions you're going to claim. So then when you file the 1040, it should match up really close so you don't owe or get too much of a refund. If you want a huge refund, then you should have a bunch taken out of your weekly paycheck and file single with no allowances. That's going to have the most taken out, but you'll get the most as a refund. So I wanted to go through an example of a W-4 just to kind of let you see what it, make sure you understand how to fill it out, because anytime you get a new job, you will fill this out. So okay, let's look. I'm going to pull up a W-4 in just a second, but this is our little scenario. We got a married couple, the spouse works full-time, 2 kids, both under 16, and the couple makes an average amount of $50,000 total. So I'm going to pull up the W-4. All I did is just go online and search Form W-4 and was able to easily pull this up. So when you're filling out the W-4, the part that you're used to filling out if you're the employee is just the very bottom third, where you put your basic information, single or married. And then number 5 here, that's the key number that the employer is going to look at. So number 5, you need to, if you're going to do it correctly, you need to come up here and fill in these A through H. So with our individual, we're going to enter 1 for line A because they're not claimed as a dependent on somebody else's return. Should we enter 1 for this line B? You're single. Nope, that's not true. Married, have only 1 job and your spouse doesn't work. Nope, that's not true. Your wages from a second job or your spouse's wages are $1,500 or less. Nope, not true. So we're not going to enter anything for B. Enter 1 for your spouse. All right, so for C, we can enter 1. Again, it gives you the option here that you can enter 0 and have a working spouse, or you have more than 1 job. This one is kind of optional, but we'll go ahead and enter 1 here just so they don't take out too much, because I like to have money on my weekly paycheck instead of getting it all back as one big refund. But that's one where you could go either way. D, enter the number of dependents that you'll claim. Well, we're going to claim our 2 kids, so we would put 2 here for D. E, we're not filing head of household. We're doing married filing joint. F, enter 1 if you have at least $2,000 of child care expenses. It doesn't state that in our very many problem, so we're not going to do anything with that. G, child tax credit, including the additional child tax credit. It says here if your total income will be less than $70,000 or $100,000 if married. That is us. We do fall in that category. That's why I gave you the wages for this couple. We're going to enter 2 for each child, and then less 1 if you have 2 to 4 kids. All right, so if we enter 2 for each kid, that would be 4, but then it says less 1 if you have 2 to 4 eligible children. We do have 2, so we're going to put in F 3. We're going to put 3 here. Well, not in F, in G. In G, we're going to put 3. Now in H, all we do is add them up. So we had 1 for A, 1 for C, We had 2 for D, so that's 4, and 3 for F. So this individual could claim 7 allowances, and it should work out. Now 7 is quite a bit. For a lot of people, if you claim 7, you won't have any taxes withheld. So you want to be careful. You better have, if you want to be making probably at least 50,000 or more to claim that many, 7. And you'll see that when we start looking at the tables to how much you should take out with the allowances. So down here on line 5, we would claim 7. If we wanted additional amounts taken out, maybe every year we seem to owe, you could go back and take this number down and fill out a new one and say, I want to make it down to 6 or 5. Or you could say, I want you to still use 7, but take out an additional $15 per paycheck. So that $15 will continue to add up over each paycheck, and then that'll help you not owe hopefully as much, or if any, and maybe get a small amount of your money back as a refund. In line 7, if each year you never end up owing anything and you always get a refund, but you'd rather not even have to file and get a refund because you make less than $10,000, you could simply write exempt here and no taxes will be taken out of your paycheck for federal withholding. All right, allowances. Notice here, each allowance claimed reduces how much you have withheld. Now, when I say this, each allowance claim reduces your taxable income by $4,050. That's not quite true. I'm gonna change this up. Oops. When you're actually doing the 1040, it's called an exemption. Each exemption that you claimed reduces your taxable income. So let's put that claimed on the 1040, reduces your taxable income by $4,050. Every time you add an allowance, it's kind of the same as an exemption, but not quite. Because on the tax return, we would have only claimed 4 exemptions for the 2 parents and then the 2 kids. But notice the allowances, we claimed up to 7. So they're not quite the same because the allowances take into effect the child tax credit. They take into effect the child dependent care, a few miscellaneous other things like head of household. Okay, so you can see here what I had about line 7. You can write exempt again, but if you do that, you're going to have to do that each year. That is only a 1 year. That's only a 1 year exception for you to be exempt. If you don't have exempt and you put 7 in there, that 7 will be there until you go back and change it. So you do not have to redo your W-4 each year, which most of you will probably know that because you've never had to redo your W-4. All in all, with this kind of summary here, if you expect to come into more money somehow and federal taxes are not being taken out, maybe through a retirement fund that you got a lump sum, and you need more taxes taken out of your check, you can always go to your employer and refile that W-4. Just ask for a W-4 and put that you want $15 taken out of your check each paycheck this year, and then refile at the beginning of next year if you're ready for it to start over. The last thing that you can have taxes taken out is if you do get a retirement distribution, if you are of age and you start drawing on a retirement, if they're not taking out enough or potentially too much, then you can file with that retirement company what's called a W-4P. So it's just like the regular W-4, just slightly different because it's for retirement. And then you can put on there exactly how much you need taken out by number of allowances and what your filing status is. Note here, by default, companies will use a rate of married with 3 allowances so they do not have to send out a questionnaire each time somebody starts drawing retirement. They're going to default to married 3 allowances. So if that's not you, if you don't fall into that category, they're not going to be taking out the right amount, and you may end up owing or getting a huge refund back because they're taking out too much. Okay, now Now let's get into the part, how do we determine exactly how much taxes should be taken out of your check? The best way, and maybe the easiest way, is just to look in the back of your book. In the back of your book, in Appendix T, and this is also for the ebook online, you will be able to find the tax tables. Now, for future years, when you don't have your tax book, it's also good to know where to look up when you can just go to the web. And I find the easiest way is just to go pull up and search for the 1040 instructions. So that's what I did. I went into Google and I searched for 1040 instructions. And you get an entire, it's a 106-page document. If you scroll all the way down and it starts on page 77, I've moved down to the middle categories of income levels. This is where we're going to begin to know how much to take out for an individual's. Excuse me. This tells me here how much they owe. What we want to know is on the publication 15. So we'll go back to Google. This is how much you would want to owe if you were doing the tax return. But what we want to know is on publication 15. So just look up publication 15 in Google. And we want to use the 2016 because that's what our software is. So publication 15, and then make sure we put in for year 2016. We want to keep with the same year that our software is, so we don't, here we go. So everything, the answers are going to be the same when you go in to fill out something in the homework. Every year it does change just a little bit. Okay, let's get this uploaded. All right, we're going to go down to, I think it's here, line 42. Yep, here it is, line 42. We're going to come back to this because we're going to use this for the long method when we have to use the long method. And this is also used for the long method. But what we're going to look at first is when you can just use the short quick method. So I'm down on publication 15. Let's see what page I'm on. Hold up. Here we go. Page. The long method starts just above page 45. This is page 45 here. So if we scroll down just a tiny bit more, now we are in page 46. So page 46 of publication 15. I'm going to need to change that. I was thinking of a different class when I put this on here. So we want to go, are found in publication 15, starting around page, and I'll just put 46. And make sure, again, you pulled up year 2016. All right, let me quickly kind of run through what these tables are. First, with these tables, if you are able to use these tables, you want to pick which filing status you are, because there'll be a single and a married for each payroll period. So if your payroll, if you get paid every week, make sure you find the weekly one. Because as we go down, this one is for married weekly. Then we go down 2 more pages, and you're going to see single bi-weekly. And then you'll go, if you keep going down, you'll see semi-monthly, and then monthly, and then there may even be an annual one. Now, the other thing, notice these wages. These are for, when it says, and the wages are, what it really means is, and the federal taxable wages are. Don't look up your gross wages, look up your federal taxable wages. And then note here, they are at least, but less than. So make sure you are in least and less than. The last thing that some people get confused of, they'll see the first column, and then maybe they'll have scrolled down just a tiny bit too far, and they'll assume that that first column is the one withholding, one allowance, but it's not. Notice the first column is for those who claim 0. And that would be, if you claim 0, that basically means somebody else can claim you as a dependent. Therefore, you can't even claim yourself. Now, we'll get into the long method when we look at an example here. But the first thing is I wanted you to know where to get to these tables. Again, you can do it just as simply in the back of your book, or you can go to publication 15. And then the allowances, that comes from the W-4. All right, let's, oh, there's one more thing before we look at an example that I do want to, I guess, I don't know if we really need to touch on these too much, but marginal and average tax rates, we learn a lot more about these in the actual tax class in Accounting 205. The marginal tax rate is how much money would you pay if you made $1 more, and what percentage would that be at? There are, right now, currently, there are 7 tax brackets. Those change just about every presidential cycle. Not every one, but it seems like at least maybe every other one. They'll change. They'll go from 6 to 7 to 5, and the brackets will slightly adjust. Right now we have 7, and they start at 10%, and then 15, and it goes up to 25. All the way up to the highest bracket is 39.6%. Your average tax rate, this is if you made $1 more additional dollar at your top dollar amount. This, however, is what you make overall, how much taxes you have to pay. So it's generally going to be lower than your marginal. It could be the same, but it'll never be higher. Because on the average rate, your first few tax dollars, no matter if you make $1 million or if you only make $100, the first $100 you make are taxed at the same rate no matter who you are. It's only those additional dollars when you get up in higher compensations are taxed at a higher rate. Those first few dollars you earn every year are taxed at the same as if you earned very little the whole year as well. All right, I wanted to go through now an example of how to do the long method calculation. So with this practice example here, we've got an individual who is biweekly pay, filing single, and they have $3,000 taxable federal income. We want to know how much withholding should they have if they have 2 allowances. All right, let's do this. Let's the long method. What we're going to do is, again, you can go back to in the book. It's probably the easiest. You go into the pages T1 and T2, T3. That's where you're going to have this right here. This would be like T3, I believe is the number. It may be T4. This would be T2 or T3. The first page where it says weekly, bi-weekly, semi-monthly. And then your first page, if you're in the book, is going to have, and I believe it's this next page up. So hopefully things aren't slowing down here on me. Okay, yeah, here it is. You should have a table that looks like this. It'll have what are you allowed to claim for the number of allowances you have. So in our example, let's go back to it. This individual has 2 allowances. And if we look again, they are paid bi-weekly. All right, so we go to bi-weekly. They are paid $155.80. You only have to use these tables if you use the long method. You do not use this table if you're doing the short with the charts. The charts already have this stuff built into them. This is only for the long method. So this individual is bi-weekly, 2 allowances. So the first thing we have to do, and you'll see this when we get to the chart. Oops, I was scrolling down on the wrong one. Let me scroll down on the correct one here. We're going to now have to do the long method, and remember it was $155. And for somebody who's bi-weekly, who's single, it says over here, if the amount of wages after subtracting your withholding allowance. So that's the first thing we have to do. We have to take, and you can see here what I'm doing right here. We have to take the 3,000 minus the withholding allowance, and we had two of them. So 3,000 minus the 155.80 times 2, this is what it comes out to be. This is the number then we are going to look up in the charts. And then we are going to work backwards. So we're going to look up 2688 and see where that falls for the individual who's biweekly and single. 2688 falls here on the third row. Whatever percentage you see here, that's what the person's marginal tax rate is. For every dollar they make in addition, they're going to pay 25%, which is pretty high. So that's one of the first answers we were asked to find. What's their marginal rate? That you can get by whatever percentage they're in. Now, what we want to do now is work backwards. Take the number that we just got after we did the subtraction, and then subtract again. Subtract this number that's way out here, and you can, I try to use the tables as much as I can. So this reminds me as this big dash here. It's not what it's really for, but it's for, I think of it as a subtraction signal. I'm going to take that 2600 number and subtract out the 1535. So the 2688 minus that 1535, what we're left with is how much do I tax now at 25%. So once I've subtracted the 1535, I then multiply by 25%. Here we go. Multiply by 25%, you get $288. And then the last step, all we need to do is once we get that 288 is plus, it tells me, plus the 199.40. And so that's what I did here, plus the 199.40. So my total tax for this individual to be taken out bi-weekly is $487.75. I could have also gotten the average tax rate at this point. So the marginal tax rate was 25%. That's what bracket they were in. And then I could have taken, all right, we took out $487.75 divided by your total federal taxable wages, and that's what our average rate is. So notice it's quite a bit lower than the marginal, and that's how it should be. All right, now what I want you to do is take lecture example number 2 and practice the long method. Semi-monthly married, 2010 taxable wages, and we want to determine if they have 4 allowances. Do the same thing we just did. So go ahead and hit pause, and this is a good example to try the long method on. Okay, hopefully you have solved this one on lecture example 2. I want to pull up the answers and see how close you got. Remember, the first step you need to do is take the 2010 and subtract out the number of allowances for this pay. This pay was just a little bit different one than the one before. This is a semi-monthly. So you need to look up the semi-monthly in the allowance table, and it's going to be just a tiny bit higher than what it was for biweekly. Then this is the number we're going to want to look up in our tables for somebody who is, remember, they are married semi-monthly. Married semi-monthly. So let's go to their married semi-monthly. So now we're on this side of the chart. And let me get my number again. We were looking up 1334 We just barely make it into this second row. So this person is only in the 15% bracket, marginal rate. And then you want to work backwards. And if you need to pause it at this point, go ahead so you can copy down the answer. Again, we're in the 15% bracket. The average rate then is simply taking the 108, how much tax we owed, divided by our taxable income for federal withholdings. So really, we only pay 5% in tax, even though our marginal rate did jump up to that 15% bracket. Now, all right, let's look at lecture example number 3. Becky, single. Let's take one step back here. What I wanted to do with lecture example number 2 is I also now want you to use the tables. Use the tables and further back, because this one you can. You can look up $2,010 for somebody in the semi-monthly married category. So let's do that. Let's look up 2010 in the semi-monthly married. So that's going to be a few pages down. So this is the bi-weekly. It's further down than that. Here's single semi-monthly, so we're getting close. I want single, I want married semi-monthly, and I want it to be 2010. Remember, I don't need to do anything with the allowances with that previous table. I just want to take 2010. So 2010 falls right here. This individual had 4 allowances. So 0, 1, 2, 3, 4, $108 is how much they should have taken out. And you can see if we did it the long way, it was $108. It came out the same. Now go ahead and pause and do for lecture example number 3. You're going to see that with lecture example number 3, you cannot use the quick way. You have to do it the long way. The tables do not go up to 3,000 for somebody who is single semi-monthly. So you have to do it the long way. But then what you also want to take into effect here is that you don't even want to use 3,000. That you're going to want to use 3,000 minus. Remember, this is her gross income. When I start telling you she has other things deducted that are things like medical premiums or 401k, we can deduct those and not pay tax on them. So really what we're going to look up in this instance is not 3,000, but 2,600. So you're going to want to do 2,600 the long way for example 3, because again, 2,600 still will not fall within the tables for somebody who is single. I hope you hit paused and you filled this one out, because that's the best way to learn this. If you just keep listening to the lecture and you don't hit pause and you don't work them out, your chances of doing well in this class go way down. It's actually beneficial if you take the extra 3 or 4 minutes, pause and work it out, and see if you get the answers that I do. So here are the answers. When you look up the long version, subtract out the exemptions, and then go to the charts and do the math. She's going to owe $365.90 every single pay period. Lecture example number 4, and this is where we end for this lecture. So this is the last thing you want to do. Read through this. What I want you to first determine is what your FICA taxable pay is and your federal withholding taxable pay. You cannot go through and do the rest of this without these 2 amounts to find your tax. So with Jessica being single and 2 allowances, she earns $1,450, but that's gross. That's her gross amount. We need to determine her taxable amount. So take about 2 minutes and get that, and then we'll work down at the bottom. Okay, her gross amounts You should have gotten a FICA taxable pay of $1,200 for the 2 items that she's allowed to deduct. You can't just deduct everything that's given to you. It's only the items that we discussed previous in the lecture. And the federal withholdings, she can deduct the extra 100 in 401k, so that's why it's slightly lower. We're going to use these 2 amounts then to fill out and to help us fill out the payroll schedule here, the payroll register. So again, pause, fill this out for the next 4 or 5 minutes, and then I'll show you the final answers. All right, our final answers for lecture example number 4. This is what you should have gotten. Gross pay, $1,450, so that's going to be our starting point when we actually calculate the net pay for the check. That's the only reason I have that on here. For Social Security, I'm going to multiply 6.2% times this number. For Medicare, I'm going to multiply 1.45% times this number. For the 1,100, I'm actually going to go to the tables, and let's go ahead and do that. $1,100 is our taxable income, and we're going to look up somebody who is single and biweekly. So we go up on our charts a little bit to single biweekly. We should be able to find this in the charts and not have to do the long method. All right, here's married biweekly. Let's go up just a bit. And we are looking for 1,100. Single biweekly, 1,100. Remember, it's at least 1,100, but not more than 1,120. That's us. We had 2 allowances, so it appears it should be $89 of tax taken out. And that's what it shows here, $89. That's where I get that. Medical premium, that's just straight taken out of our check, minus the flexible spending, minus the 401k. When you take the $1,450 gross, subtract out each one of these, you should get $919.20. All right, that's what we have here for week 4. The next week, we're going to look at the W-2 and then putting all this information together to complete the 941 again and do another payroll register assignment for week 5. But this week was just getting us introduced to everything with federal taxes. Next week, we're going to do a bigger item. Remember to send me your homework by the due date, and I will check return by email, and then you could submit by this class's due date.